Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Paul Sweeney live here on the Bloomberg Interactive Brokers Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg.com. My first trade on Wall Street, Johnny Coughlin leans over to me, my head trader, block desk at Paine-Webber. Buy 300,000 shares of Pan Am at 31.5 and do not lose money. I'll give you all day to do it. I did. I made about $4,000. It took me almost the entire day to get this trade done. 6 months later, I did it in 10 minutes. But
amazing.
Anywho, that's my heritage on the block trading desk, trading equities. But now Sridhar Natarajan, who covers all of Wall Street for us, has got a story that I don't like. Because it's got Citadel Securities crafts a plan to shake up banks' trading desks. I like the trading desk. Are they being disintermediated to some degree?
A very good morning to you as well, Paul.
He likes you, just not the sheets, just to be clear.
No, but that's a word we do not use in the story, but in some ways that's a good way to think about it. The difference between when you were at Paine-Webber and now is the industry model has changed dramatically.
Yep.
A lot of trading products, especially ones where you've seen that embrace of electronification, it's just not easy to make a lot of money in that business. I go back to this famous Bear Stearns trader who was known as Two Sticks Eddie. He got that name only because he would buy something at 97, sell it at 99, always had that 2-point spread. That's not what's available. Now it's the technology, the process, the execution, it's the plumbing of the system has changed. It's not so much driven by relationships. And that has allowed these players, these market makers on the edges of that trading ecosystem to come in and really take market share. That's where you've seen people like Citadel and Jane Street and Virtue actually starting to gain share. They're still not as big as the biggest players, but where they do have an advantage is because the trading landscape has changed, because so many of the products are becoming categories of one or two. You're one or two top players in that space, and outside of that competitive mode, everyone else is struggling. Everyone has to identify their niche. And that is where someone like a CitSec can come in and say, our niche is great technology, great analytics, great ability to execute and process. Why don't we go to some of these struggling banks, people who need to offer these services but can't really afford to offer these services, the tier 2, the tier 3 banks, the brokerages, and tell them, we will do it for you. We will be your engine. Just slap your name on it. Tell the clients you're still doing it, but split your commission with us. Your costs go way down, and you will show a better return on equity, which at the end of the day is the most important thing all of them are striving for.
Okay, here's my super dumbed down question. So if that happens, what would Paul's trade of Pan Am back in the day look like? How would that now be different?
It's just that Paul won't be doing it. He will be sending it off into the pipes and someone else will be doing it for him.
He just puts in an order and then it just goes and happens and he has nothing. He doesn't have to sit there all day and manage it because Citadel is working on the pipes.
It's not like client ABC comes to Paul and says, hey, here's the deal. He takes it from him and then flips it around to XYZ and makes the spread. It's just become harder, especially in equities. Even in other products that you would not have previously thought about as low touch, they are becoming low touch. Think about corners of the credit market that you would not have thought would be easy to electronify. But that's happening, and that's happening at pace. But the bigger, I guess, academic question here is, if you're a client, and the simple way to think about it is, it's like if there were some banks, if there were some tier 2 banks that were to embrace this model, and you're a client going to them, it's almost like a Starbucks selling Dunkin' Donuts coffee. How long does a client keep going to Starbucks to buy that Dunkin' coffee instead of going to Dunkin' directly? And that's Citadel's opportunity because it is also doing that. It has also got a platform where clients come straight to them. But it's not all going to happen at once. That intermediate term can last a while. So if this plan, which is still, let's be clear, a bit pie in the sky, but if they're able to roll this out and if they're able to get people to embrace this, that intermediate term can last a while. And that could enable Citadel Securities to make a bigger leap in the business quicker than otherwise. And that's important because this trading firm of Ken Griffin's it's clear to us, it's clear to a lot of people in the market that in the coming years, it will IPO. And it is going to have a pretty valuation because it is completely focused on having high ROE, low capital intensive businesses because they are convinced that's what investors and analysts like, and their entire model is around taking that piece of it and scaling it.
Does Citadel's trading operation, third-party trading operation, do they put up capital to facilitate trades, or they just do it with flow? Because, I mean, part of the reasons that people would pick up the phone and call me back in the day is that I would put up some capital to facilitate a trade, put capital at risk to facilitate a trade. Now, that first day I wasn't allowed to put up any capital because I would probably have lost it. But that's kind of how it goes. Are they putting up capital?
They do. I mean, and again, we'll have to go through the numbers, but there are some disclosures. I believe the Citadel Securities capital is somewhere close to 8, 9, 10 billion. Jane Street is perhaps double of that. The big banks are probably 8, 9 times that. So yes, you can't play this game without any capital. It's not as intensive as the bigger operations because they're not doing some of the harder stuff. They're not doing some of the prime brokerage stuff, which is the financing business, where a lot of the capital intensity comes into play. And that is by design. They're saying we don't want to chase that capital intensive stuff. We don't want the regulators to be breathing down our necks. We will do the stuff which requires efficient use of operating expenses, up to date, new age tech stack, which is very different from a lot of these other older players who are struggling with creaking technology, burgeoning operating expenses, and not cutting edge analytics. Citadel believes it has all of that. And that is what gives it that agility and nimbleness, at least that's how they see it, to go in there and offer a service like this and also outcompete some of their bigger rivals.
So who would this be bad for?
We know who it'll be good for.
Okay.
Citadel Securities. Who will it be bad for?
Yeah,
the way they are making the pitch is they're going to all of these, or they will go to all of these tier 2 players and below and say, it's not bad for you. It's mutually beneficial. If we weren't there, you would be having serious conversations with your board about what products do you need to exit. Because some products just don't make money and you can't just carry along that dead weight forever.
But in theory, those tier 2 companies then will be losing some of their...
They will be losing some of
stream.
They will be losing some of their sway. They will be losing some of their commission. In exchange, they get higher profitability. So they have to figure out if that trade-off is worth it.
I think one of the concerns I would have if I were a Deutsche Bank, I know it was mentioned in your story, do I want to give up A, the commissions, and B, my relationships? Because I think the market's going to know that I'm not really in the game and allocating capital and all that kind of stuff. And what does that mean for my clients if I'm not in there? I'm farming out a lot of this capital risk and so on to and execution costs to Citadel.
Hence, why not just go right to Dunkin' Donuts and bypass Starbucks?
Yeah, so I'm sure they're going to have to think about that. But for a lot of the second tier terms, it might make a lot of sense.
Right, and even Deutsche Bank, which I would not necessarily consider inside the competitive mode. I mean, they exited large parts of equity trading. Who are not going to be a part of this process? They're not going to Goldman Sachs and JP Morgan and Morgan Stanley and say, we're going to supplant you, right? Because those three are squarely inside that competitive mode. It's when you step outside of that area that it becomes extremely challenging.
All right, Sri, thanks. Good stuff. Sridhar Natarajan, senior finance reporter, Bloomberg News. He's got a story I don't particularly care for, but I do understand it. It makes some sense. So we'll see if our good friends at Citadel can float that down the street here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get a broader take on the market here. Emily Roland, one of my favorites, co-chief investment strategist for John Hancock Investment Management, joins us now. Emily, the reaction is clear, right? The S&P responding more to earnings, and you have the bond market and the currency market responding to that CPI data. What's your take over the last couple hours?
Oh, so much relief right now, especially seeing that shelter component coming in at 0.2%. Month over month. It just felt like it was Groundhog Day. Every time we've gotten CPI reports this year, it's just been that sticky shelter component. And I think there's a lot of relief that that's coming down. I think the challenge that the market's contending with right now is when does kind of good news on disinflation maybe put pressure on growth and corporate earnings? So the way that we've been thinking about it is, yes, disinflation traction is great for consumers. It means the Fed can start cutting. And I think we've solidified a September cut after today's report, but it's not necessarily the best thing for corporate revenues. In fact, we're finding that a lot of companies are now having a harder time passing those prices along to the end consumer. If you look at the guts of the CPI report today, it's stuff people want, right? Like Alix, clearly you want to go to Idaho, but it's things like airfares, it's things like cars, used cars, new cars, it's things like, other sort of discretionary items that are falling because companies have less pricing power. That means revenue growth might slow. At the same time, the cost of capital is still elevated for companies, so their margins are going to come under pressure here. And I think that's the reason you're not necessarily seeing that massive pivot party that we've seen with other CPI releases coming down, because it's not the best thing for corporate earnings from here.
Well, I'm a former equity analyst, but I know all along that the fixed income folks are much smarter. The bond market's definitely reacting to what's happening out there. We got the 2-year, as John Tucker likes to call it, the most interest rate sensitive and Fed sensitive instrument out there. The 2-year Treasury, it's off almost 12 basis points, 4.5%, and we were at 5.02% on April 30th. So big moves in the bond market. What's that telling us, Emily?
Yeah, so we've been suggesting that investors lean into high quality bonds over the course of this year, even though the path has been bumpy. I mean, it's amazing. We started at 3.88 on the 10-year Treasury yield this year. We're still not even there yet, back down to that level. So it's like the bond market hasn't really sniffed out this disinflation trend yet. So we were suggesting that investors take advantage of that big backup in yields that we've seen to lock in those higher interest rates. When the Fed does start cutting, when rates start to move lower, it can happen really quickly. So many of the investors that I've been talking to this year, we're just going to wait for the Fed to cut in order to leg into duration a little bit more. The challenge with that is that you're going to miss out on a lot of the total return potential in bonds if you wait for the Fed to cut. We know that the 10-year Treasury yield, or really the entire yield curve, is going to sort of suss that out before the Fed actually starts cutting. So that's why we think it's important to get paid income here while we can at these elevated levels, close to 20-year highs on bond yields. Pretty awesome.
So then if we just go from the 10 for a second. So steepener trade seems to be in play today, but that's more because the front end and the stronger buying in the front end. How do you want to be playing that?
Yeah, I mean, we are suggesting essentially looking at the intermediate part of the curve right now for the best opportunities, looking at 7 to 10 years of maturity. And again, locking that in. Right now, the trends that we're seeing is that it's cash, CDs. There's $6 trillion, Alix, sitting in money market funds right now. That is unbelievable. And so what we're seeing is investors are loving getting paid this close to 5% risk-free rate. But our contention is, hey, by the way, that's fine. It's great that there's something else to do with short-term cash, but it's really a terrible long-term investment. So just going out the curve, embracing the intermediate part of the curve, locking in that 5, even 6% income for many, many years, we think we're going to look back and really identify the fact this was a great opportunity to take advantage of these higher yields before inflation comes down even further and the Fed starts to cut.
How much credit risk should I take here, Emily, or should I just stick with my safe treasuries?
I mean, I know it's boring, Paul. I know it's boring to just love high quality bonds. But when we look at high yields right now, the yields are elevated, of course, but you're not really getting rewarded. I mean, spreads are still sitting at around 300 basis points above treasuries on high yield bonds. That is pretty unusual. We actually did some analysis suggesting that when spreads have been this tight, the forward-looking 12-month returns on high-yield bonds are right around 0 to 1% historically, looking over the past 40 years, with a range of +10 to -10. So to us, you just don't need to go down the credit spectrum anymore to generate impressive yields in bonds.
Where is the riskiest spot right now?
Yeah, so it's really in lower quality, sort of growth at any price on the equity side. So we talked about the risks in bonds, but on the equity side, seeing small caps rallying today, I'm actually a little bit surprised by that. Because what we saw for most of the last year was that small caps were the biggest participant in the pivot party, right? The idea that the Fed can resume cutting, the cost of capital can come down. That's awesome for companies that have the highest levels of indebtedness, right? But what we started seeing recently over the past month or so is small caps weren't getting as excited about rate cuts as they once had, because again, it means it puts pressure on revenues, it hurts margins, and it hurts the lowest quality players. So we would be taking an opportunity right now to kind of sell out of growth at any price, meme stocks, if you will, riskier small cap equities, and kind of lean into higher quality stocks that have great balance sheets, tons of cash, and a limited need to tap the capital markets in order to grow. We think those still do well in this decelerating growth environment.
All right, we kind of, I think, in earnest beginning to kick off earnings today. And of course, we'll really do it tomorrow with some of the big banks led by JP Morgan Chase here. What do you need to see? What do you think the market needs to see from this earnings season?
Yeah, I mean, the trickiest part now is that we finally have a high bar again. Not that that's a great thing, but 8.8% earnings growth is what analysts are penciling in for this quarter. It's the first time in a while that we've had an elevated bar. That would be the highest earnings growth since Q1 of 2022. One thing we're looking for, though, is that 8 out of 11 sectors in the S&P 500 are expected to see positive earnings growth this quarter. So if that does come through, that would help broaden market breadth, which I think is really important for markets given the level of concentration we've seen across mega cap tech names. So I think if earnings can deliver, 9% feels a little bit overly optimistic to me, then we can get that market breadth that everybody's looking for.
Mm-hmm. You know who says 12%? Gina Martin Adams of BI. We're going to talk to her next.
Yes.
Because that's even here's a bar, and then we're going to rise above it. Emily, before we let you go, though, your thoughts on AI. Goldman had a really interesting note out that talked about maybe the hyperscalers won't be investing as much as maybe we thought. Does that change? How does that wind up affecting AI trades? What do you think?
Yeah, I think what we're going to be looking for this earnings season across those big AI names is, again, back to the monetization of it. How is this being monetized? How is it producing productivity benefits? And to your point, where's the budget prioritization across these companies? So we'll be looking for kind of who the winners and losers are across that, especially as it comes to how does everybody monetize this incredibly powerful productivity driver from here.
Great stuff. Emily, thanks so much. We appreciate you. Emily Roland, Co-Chief Investment Strategist for John Hancock Investment Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news and analysis with our great Bloomberg Intelligence team. They cover 2,000 companies and 130 industries worldwide. And we also take you outside to talk to some CEOs, economists, analysts, and also get their take on what's happening. And for this, we go to real estate because housing stocks are getting a nice boost today, whether you're looking at REITs, whether you're looking at home builders, all thanks to those lower yields. So we're checking in now with Steve Jacobs, president of 10X. He's joining us from Irvine, California. And 10X is apparently the largest online commercial real estate auction platform. So it's a great window to give us a viewpoint on CRE market. Thanks for joining us, Stephen. We really appreciate it. Can you just talk me through how the largest online commercial real estate auction platform works?
Sure thing. Nice to talk to you. So we're in the business 13 years, and the difference between being online and offline is using our technology. Our customers do their due diligence when they're looking to buy a piece of commercial real estate before they actually purchase it, versus offline due diligence is done after they sign a contract. And by doing that, we shorten the time frame between marketing and closing a deal to about 100 days, 90 to 100 days versus a 6-month process. We also eliminate the risk of retrades and fallouts. We have a 98% closing rate, and we've helped brokers trade over $32 billion of commercial real estate over the last several years.
All right, so Steve, from your perspective, can you give us a sense of what you're seeing out there into the health of the commercial real estate market? Because that obviously it impacts folks in that business. It impacts the banks that finance that business. So investors are really interested in this space. What are you seeing?
So I've been, since the interest rates, it's going on 2 years. It was July 22. They really popped up. I have a phrase, and it's not that exciting, but it's just math, right? And when interest rates were 3%, cap rates on investments were lower. All right. Now what's happened is with interest rates going up to 5, 6, in some cases 7%, it just changes the value of the real estate. It changes what your investment return is going to be. So what's happened in sort of the state of commercial real estate is there's a lot of owners that own very nice pieces of real estate. There's nothing necessarily wrong with them, but the capital stock and the math has just been sort of sort of turned upside down, if you will. And what if a building was worth $10 million when your cap rate was 3 to 4%? Now your cap rate is 6 to 8%. Your building is worth $7 or $8 million, and that has caused a lot of what I like to call stress for owners, because it has put values in some cases underwater based on what the debt is and based on what the value of the real estate is. It doesn't mean it's a bad piece of real estate. It could be a great piece of real estate, fully occupied, people paying rent, getting your NOI, your net income on the asset, but just on a value approach, it's worth something less than it was.
So when you look at the buyers and the sellers and the gap between maybe what the pricing looks like, how has that changed, say, in the last 6 months? And what do you think it's going to change in the next 6 months?
So that's a great question. So it's very interesting. So the gap has existed for a couple of years, to your point. And what we saw at fourth quarter 23 and going into the first quarter of 24, we saw more activity, more interest from the investors really stepping up on our platform, bidding and buying assets, because the messaging that came up from the Fed is we're done raising rates. What we've now seen coming out of Q2 is still seeing similar activity. We are seeing buyers be more reserved, because what we think, or what I think, that the investors are waiting for is a message from the Fed. More than a message, we're reducing rates. Even if it's 25 basis points, the act of reducing the rates will set the tone going forward, and give more confidence to the underwriting for the investors that there is value in their underwriting, because rates will go down.
Steve, one of the fundamental problems with office real estate is I don't think anybody really knows where the market is. I think if you drive through any town USA and any generic office park, every single one has that sign in the grass telling you about how much square feet is available. With occupancy levels where they are, what is the value of commercial real estate? Are you seeing activity there?
So you're specifically asking about the office?
Yeah, office.
Yeah. So you're right. And I can tell you on our platform, we've actually been very successful in the last 6 months to a year of trading, helping brokers trade office assets, but it all comes down to what the pricing expectations of the seller is. And based on what I said earlier, you may have and in this case with office, a 50% occupied office building. It doesn't matter really how nice it is or how nice the common areas are and the various improvements that have been made. If you have a 50% office building, 50% occupied, you're kind of in trouble, because what I think landlords and owners are searching for is how to get people back into the office space and how to lure companies back in. And I just think beyond the real estate, I think businesses and companies are struggling still with how do we get our employees back in. So if you have a suburban office building that's half vacant, and it's an older building, maybe a class B or C, you got to really get real with the value. And if you get real with the value, and you might have to take a hit, somebody will buy it. When that person buys it at quote unquote a discount, what the new investor can do is then lower it's a lower basis, right? So they lower the rent. So all of a sudden, this particular suburban building that might have been charging $25 a square foot under one financial model, because it was purchased several years ago, now can come in, buy it at a lower price, and now they can have the space be $12 a square foot when the rest of the market's 20. and that's how they'll attract tenants. I do think there's been a lot of discussion about urban downtowns and how they're really in trouble. But also the flip side of that is that the Class A, so the best quality office buildings, are attracting tenants. I do think that they're giving a lot of incentives, and there's a lot of negotiation going on as far as pricing the leases.
Stephen, we just have about a minute left, but I was wondering, what about mixed use stuff? So you have an office building that's only 50% occupied. How do you get other people in there to do other stuff? Like someone was talking to me about a hotel that just encompasses 4 floors of a previous office building.
So there's a lot of discussion about that with regards to repurposing these buildings. Some of them can be, some of them can't be, but a lot of these buildings were built for office, right? So they don't have the right templates, the floor plates, right, to actually convert to hotel. Like think about it, a hotel room, needs windows, right? Every room needs windows, right? Office space, you need windows, but you can have people sitting out in the middle of the floor not by a window. It's the same with converting them to multifamily. Not only is it expensive, super expensive, but it's not as easy as it sounds. And also you have to look at that market demand. You could have a 2 or 3 story office building in the middle of an office industrial park, and I don't think people want to stay in that as a hotel or a residence.
Yeah. We appreciate this. This was really interesting. Thank you so much, Stephen. Come back and let us know how it's evolving as the Fed moves towards those rate cuts and as yields move lower as well. Stephen Jacobs, president of 10X, joining us on the state of commercial real estate. But that's so hard. Like, how do you price something that's going to evolve over the next 5 to 10 years, right?
Yeah, it's really, really tough. And I just, and what we hear is reconfiguring those buildings is very difficult.
Yeah.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get to that CPI number and then the market reaction, right? The S&P is down by about 0.5%. You're still seeing a bid into the bond market here with yields lower, dollar lower, as the CPI number cools. Lindsey Piegza is chief economist over at Stifel, and she joins us now. All right, Lindsey, what was your take? We already saw JP Morgan move up its cut estimate to September from November.
Well, I think that might be a little aggressive based on 1 month improved data or a 1 month better than expected report. I think rather this supports the Fed's message of caution as inflation slowly resumes its previous disinflationary trend. But we want to be careful, and the committee wants to be hesitant not to repeat its earlier overzealous assessment of improving inflationary conditions, which, as you remember, at the front of the year was met by a number of head fakes. So despite the fact that we're seeing improvement in the data for now a couple of months, despite the fact that we're starting to see more cooling labor market conditions, this still falls short of that bar that the Fed has set at many months of good data. But that being said, each improving data point, the Fed and market participants, as we see, are increasingly optimistic that a policy change is around the corner.
Lindsey, I guess with a little bit of hindsight now, what do we make of that first quarter, those 3 reports on inflation that came in a little bit higher than expected? Were those seasonal? Was there something structural, or was it just a blip in a generally deflationary longer-term trend?
Well, I think this just underscores the bumpy and uneven nature of inflation. I don't think you can pinpoint one component to say that's what drove inflation higher, but rather it's a broader message of inflation is not on a clear-cut downward trajectory. We are going to continue to see unevenness and volatility in the numbers. And so this is where the Fed needs to really stay vigilant in its focus on reinstating price stability, not just hoping that we're on a sustainable downward track, but really keeping their focus on that bar of many months of good data to gain that needed confidence that we are on a sustainable downward trajectory back to 2%. This is certainly a step in the right direction, absolutely, but is it enough to justify a near-term rate cut? Not quite yet.
What more, though, do you think we need to see then? So if we just fast forward to November, what in these few months will we learn? The extent to which inflation is dropping, what would you be looking for?
Well, we need to see consistent downward momentum. We saw a little bit of an improvement in April, but I'm not really going to count that as a month of improvement. We saw more improvement in May, absolutely. June, we're starting to see more improvement. So we now have 2 good months under our belt. We need to see this downward momentum, this lack of upward pressure and inflation continue, not just in July and August, but to a meaningful degree to really give the Fed enough confidence that September would be the appropriate time to take its foot off the brake and allow a less firm policy response. But again, I would caution that the Fed is somewhat nervous about making a larger judgment call on such a short amount of data, given that volatility that we saw at the start of the year.
We had 2 pretty big kind of consumer-oriented companies report some weaker than expected results today, Pepsi and Delta Airlines. I still don't get the Delta thing. Every plane is packed that I go on. But it kind of goes to the question of how is the consumer out there? How do you view the consumer today?
Well, the consumer is still resilient. Now, there's no doubt that the American household is feeling the pain from higher prices, higher borrowing costs, the resumption of student debt payments. But we are seeing the consumer continuing to spend. It's more of a second derivative decline, a slower pace of still positive expenditures, as opposed to an outright decline in that spending pattern. But we see the support stemming from a combination now of organic and inorganic factors. On the organic side, with inflation coming down, real earnings have turned positive, and that's providing welcome financial stability to many households. We also still see a lingering supplement of pandemic savings. And with interest rates relatively elevated, we see positive earnings interest as well. Now, on the inorganic side, we continue to see a reliance on intergenerational wealth transfers, 401k hardship withdrawals, credit cards. But regardless of the combination, what we're seeing is there's a number of factors that are continuing to suggest a good amount of spending and borrowing power on the part of the American consumer, suggesting ongoing resilience and positive activity for the U.S., for the broader U.S. economy.
How would you categorize the job market right now?
Well, the job market is still tight, but it's less tight than what we've seen. We are starting to see signs of cooling. Headline job creation, as we saw, did face some sizable downward revisions to earlier months. But thus far for 2024, we're talking about an average hiring pace of around 225,000. That's on par with what we saw in 2023, with an average of about 250,000. So we're still continuing to see labor demand outpace labor supply, with wage pressures still up near 4%. So this is still a solid labor market, tight-ish conditions, but slightly less tight than what we've seen. And that's a welcomed improvement, suggesting that finally this elevated level of rate is having the intended negative effect on beginning to slow the economy, slow the labor market. But again, it's this very gradual decline in conditions as opposed to falling off a cliff.
Economic exceptionalism. That's a story, a narrative that I've heard, over the last, 12 months, characterizing the U.S. economy vis-a-vis, say, our friends in Europe or in Asia, particularly China. Is that something you ascribe to? And if so, what does it mean to you?
Well, I think first and foremost, we have to put the U.S. economy in the context of what we're seeing on a global basis, because as we talk about some of these nominal figures beginning to show signs of weakness, on a relative basis, the U.S. economy is faring significantly better than what we see in many of our developed counterparts abroad, which have either fallen into or teetering on recessionary conditions. So when we look at the U.S. growth rate now falling below 2%, nominally not impressive, but compared to what we've seen overseas, the U.S. certainly does appear to be the strongest component in that global picture post-pandemic, in this post-pandemic environment.
So was it least dirty shirt in a pile of laundry? Something along those sort of lines. Lindsey, when we look forward to the election, not necessarily that will impact growth in the short term, et cetera, but have you modeled out any kind of policies, whether it's tax increases / decreases or tariffs, in terms of what the economy might look like over the next 4 years as it relates to inflation?
Well, I think when we talk about the outcome of the November election, we have to remember that in many ways, it's going to be a number of sizable barriers, regardless of who comes into power. Whether it's a second round Trump administration or a second round Biden administration, we're still going to face elevated prices. We're still going to face an ongoing divide between labor demand and labor supply, an ongoing gap between asset holders and non-asset holders. We're going to continue to face demographic issues, geopolitical risks, and international crises. And so in many ways, the pressures that are going to continue to retard the U.S. economy are going to be in place regardless of who's victorious in November. The biggest differences, as you mentioned, are going to come into play when we talk about immigration, border security, tax policy, specifically corporate tax policy, international trade, and any additional regulations that we see put in place. But the U.S. economy is on relatively sound, solid footing at this point. And I do think that we are going to continue to see this lack of momentum going into 2025, regardless of who comes into to power this November.
All right, Lindsey, thank you so much. We appreciate that. As always, Lindsey Piegza, she is chief economist at Stifel, joining us from her hometown, Chicago, Illinois, via Zoom.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Delta Airlines, weaker than expected results here this morning. Stock trading down about 5% here, dragging down the other airline stocks. What's going on out there? I can't remember the last time I got on a plane and it wasn't packed. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst. He joins us. We'll have the news. He's at Bloomberg Intelligence. So, George, what did we learn from Delta? What's going on out there in the airline business?
We're learning that fares are softer than I guess we all hope or expected. Paul, I think you just fly at core times, at really busy times for the airlines, because somehow they're not getting the same price point that the rest of their customers. Look, I think what we do know is that that the weakest part of the business right now appears to be sort of basic economy or those economy classes, and that's weighing it down. So actually, I expect that Delta's earnings report will be better than most this quarter. So I think it'll get worse and worse as you get into the low cost and ultra low cost carriers. Because again, that's I think where the majority of the pain is in fares.
Yeah, because going through the quarter, like corporate travel rose 13% for Delta in the second quarter. Revenue from international passengers also increased, and premium products jumped 10%. So basically, business people are traveling. We're going overseas, and we're buying business class or first class. So is no one going to Idaho in economy?
No, well, I mean, people are going. They're going for lower fares, right? Their load factors were great on Delta, right? They were like 87%, so they're filling airplanes as well as they filled the year prior. I think Delta will get a bit of a tailwind as business comes back. That tailwind applies to Delta, United, American, the big business airlines. I mean, management always paints a really nice picture of how everything is going, but every market but Atlantic showed lower yields year over year, and yields the price the customer pays per mile they fly. So to me, that's synonymous with fares. So what I saw was weaker fares. They were really bad into Latin America, down I think it was 12% or something like that. They were down a couple percent for the domestic market. Into Europe, it was up 1%, but if you do it on a unit revenue basis, I don't want to get too complicated about how that works, but let's just say that factors in load factors there. It was down. And so what that's telling me is that they're having a harder time filling airplanes going across to Europe at the price point they want to fill. So they notched back a little bit how full those airplanes were. So I generally think, from a revenue standpoint, not boding well at all for the rest of the airlines they're going to report. And I didn't see any sort of silver lining, for 3Q. It looks like a weakening market to me.
So talk to us about capacity out there, George. I thought that there's some capacity constraints out there which might push fares higher because maybe Boeing wasn't delivering as many aircraft as they want, maybe even Airbus as well, so the airlines didn't have as many aircraft as they really needed. Is that a capacity? What is the capacity of the industry these days?
Yeah, so I think that's a narrative that's definitely been going around the street, and I think that's pushed some investment in airlines. So we haven't seen that, right? I think there's a couple things that are kind of working against that, and I think one, I think U.S. airlines in particular have been taking plenty of deliveries. They're prioritized by Boeing, right? Boeing sort of lost business in China. China's been weakening, so I don't even know if China needs as many airplanes as Boeing used to send to them. But they went around and got a bunch of orders from Southwest, United, Alaska, and Boeing had been feeding them airplanes before we had some of the problems earlier this year with the Alaska flight. So that means most of the U.S. airlines had the airplanes they expected. We saw Delta, they added, I think, 5% more seats, and available seat miles, they added 8%. When we look at this market, we see in both 2Q and 3Q additions kind of in that 5%, 6%, 7% range for seats in domestic, seats in Latin America, seats going into Europe. And that's well above GDP growth rates. And so what I think also is going on here is if you were an airline and you thought this bounce back travel post-pandemic, hey, there's all this pent-up demand, they're all going to fly this summer, and it's going to be growth greater than GDP, I think you were wrong, right? We're basically saying we think growth in travel is recoupling with GDP like it was prior to the pandemic, and you can't add 5% seats to this market. The U.S. market isn't growing that fast.
What part of any of this, and you kind of sort of answered it, is just also tough comps because we were expecting the scenario that you just lined out?
Well, I mean, another thing we've put together recently, it's on the Bloomberg terminal under our BI space AIRLN dashboard and AeroG dashboard. We looked at return on invested capital. We looked at margins at U.S. and global airlines. And they did better last year, but if you look at last year, those margins weren't pre-pandemic margins. I mean, Delta's a bit of a standout. Their returns on invested capital are doing better than a lot of their competitors, and Ed Bastian called that out a bunch of times today on the call, of course. But most airlines in the U.S. market are not getting returns on invested capital or margins like they were prior to the pandemic. So it is a tougher comp, I guess, coming out of the pandemic. But this is not the airline industry we saw in the past decade, and that's because we got record revenues, but those pilots took a big chunk, right, when they got their 20% increases, and the airlines aren't pricing to get that back.
All right, George, great stuff as always. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence, joining us from Princeton, New Jersey. Are you flying anytime soon,
Nope.
Alix? No?
Whole lot of nothing.
Yeah.
Well, we're going to Orlando in October, right?
That's right. Go see Mickey Mouse. That'll
Yeah,
be fun.
but that's a work thing.
Yeah. So I only travel when I get paid to travel. That's my new thing. Or if I'm going to Ireland, which I'm doing in September.
Meaning that you go international, do
Yes.
a big trip, but
Yes.
you're not going to go,
No, people can come to me.
It's fair enough. I mean, he's
Right?
at the Jersey
I've done
Shore.
enough of that.
He's got stuff.
I've done enough of that.
Yeah, I don't know. I'm not going anywhere. Although my best friend is moving to Costa Rica.
Oh.
So I feel like it'll
Excuse.
be one of those
Excuse.
things where I'll be like, hey, I got an extra day. I'm going to go to
January.
Costa Rica for 3 days for $200 on JetBlue.
Yes.
Which
That'll
feels
be-
okay.
That sounds good.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.